Welcome to another episode. In the last episode, we talked about the protective put option trading strategy, and we described how you can use this strategy to protect yourself from a downside risk on an asset you own. If you haven't seen that video, please look in the description section below for the link to watch that episode. In today's episode, we're going to look at the bull put spread options trading strategy, and we will discuss what this strategy involves, how you can deploy the strategy, and what are the potential outcomes from executing such a strategy. We will use option strat as usual to visualize a sample bull put spread options trading transaction and analyze the financial impact of the possible outcomes. You can sign up for an option strat account by using the link in the description below. All right, let's get it. Before we continue, let's make you aware of a free online self-paced financial literacy program that is coming soon to a screen near you. Did I say it was free? Yes, it is free. And you will be taught about how to make the most of your money and how to get it to work for you so that you can get to that point in your life where you have enough investments that are generating income to take care of your necessary expenses. Why is this important? Imagine being able to live the life you want on your terms and not have to worry about how to pay for your cost of living. Follow the link in the description below so that you can sign up for this free training program that is coming soon. Each module should take no more than 30 minutes of your time, and it will be something that will be well worth it for you. Right, let's get back to talking about the bull put spread. So what is a bull put spread? A bull put spread is an options trading strategy that you enter into when you are bullish on a stock. And so what do we mean by being bullish? Being bullish means that you expect the value of the stock to rise or stay above a certain price within a specific period. So with the bull put spread, what you do is you sell a put option at a strike price, typically below the price where you expect the value of the asset to be on expiration of the options contract, and then you buy another put option below the strike price of the put that you sold. Bull put spreads can also be referred to as short put spread or put credit spread or selling a put spread. And the reason why you refer to them this way is that the bull put spread typically results in a net credit into your account. Now, what is the difference between a bull put spread and a cash secure put? If you haven't seen it, we have a video of a cash secured put that was created a while back. We will also leave the link to that video in the description section below. Okay, so let's visit optionstrat.com to visualize what a bull put spread looks like. First, we will look at how we can differentiate a bull put spread from a cash secured put. So if you click on the drop down under build, to look at a cash secured put, you just select the cash secured put link and it will take you to the cash secured put module on option strat. In today's video, we're going to be using ticker symbol AAL, American Airlines, as an example. And as you can see here, AAL is trading at 14.62. Now, assuming that you're happy to buy AAL at the $14 mark, you have one option. Option one is you put in a limit order with your broker, and what that will mean is your broker will block out $1,400 in your account so that when the price of AAL drops to the $14 mark, it will execute the trade for you. If the price of AAL never drops to that $14 mark, you will never get to buy AAL at that price. However, with the cash secured put, you will still block that $1,400 in your account, but you will be paid a premium. In this case, you're being paid a $42 premium for a cash secured put contract to buy 100 units of AAL at the $14 mark. And for entering into that contract, you will receive a net credit of $42. What this means is if by the time the contract expires, and in this case, the contract expiry date is the 27th of January 2023, today being the 10th of January 2023, if by the time the contract expires and the price of AAL is trading above the $14 mark, the contract will expire worthless. Your collateral will be released back to you, and you also get to pocket the $42 credit, less any fees that have been deducted from selling the cash secured put. So that's the beauty of the cash secured put compared to a limit order transaction. Now let's look at the difference between a cash secured put and a bull put spread. And so we click on the bull put spread. So let's assume that you still expect AAL to be trading above the $14 mark by the 27th of January 2023. So if we drag this button here to the $14 mark, you are able to see here from this description that with the bull put spread, what you've done is you've sold a put at the $14 mark, but simultaneously you're buying another put at the $12 mark. And the resultant effect is that you receive a net credit of $34, but you will have to block out $200 from your collateral so that you can cover any potential loss. What that means is if the price of AAL drops below the $14 mark, as was in the case of the cash secured put where you had to buy AAL for $14 per share, in this instance, you will lose $200 if the price of AAL falls below the $14 mark by the 27th of January 2023. However, if the price of AAL stays above the $14 mark by the 27th of January 2023, the bull put spread contract will expire worthless and you get to pocket the $34 less any fees, as well as have the collateral of $200 released back to you. So that's the main difference. With the bull put spread, you have a lower collateral amount, but you will lose that amount if the trade goes against you. Whereas with the cash secured put, you have a higher collateral amount, but you're getting to buy the shares at that price, which means you can go and sell a call or do whatever it is that you want to do with those shares once you've bought it. That's the difference. The returns are higher percentage wise for the bull put spread, but the risk is also higher. And for the cash secured put, the returns are lower, but the collateral required is a lot more. A few things to remember. First off, the example we're showing here is just for illustrative purposes only. It is not a recommendation for you to trade a bull put spread on ticker symbol AAL at the stated prices or expiry dates. You need to do your own research. You also need to be mindful of the impact of fees that your broker may charge for placing and closing trades on their platform, as this can affect your profit and loss calculations. But suffice to say that a bull put spread can be a useful tool in taking a profit on an anticipated bullish expectation that you have on a particular stock without having to put up the kind of collateral that you might have been required to put up to get into a cash secured put transaction. So in summary, you enter a bull put spread when you buy a put contract and simultaneously sell a put contract at a higher price, but ensuring that the put contract that you sell at that higher price is lower than the strike point that you anticipate the value of the underlying asset to be by the time the contract will expire. And so in this case, we saw that if you expect that the value of AAL will be above the $14 mark by the 27th of January, then you sell a put contract at the $14 mark and you buy another put contract at a price point below that $14 mark so that you can receive a net credit and have a lower amount as collateral. What you need to be mindful of is that for the bull put spread, if your expectations do not crystallize and the value of the underlying asset drops below the put option that you've sold, then you could lose the total money that you've put up. In our next episode, we will look at examples of bull put spread transactions that have been executed and the kind of revenue opportunities that were created. And in a follow-up episode, we will discuss the bear call spread options trading strategy, which you will see here is the next item to be discussed on the Option Strat website. And in this case, the bear call spread is the reverse of the bull put spread, where you anticipate making money and cashing in on the potential for the value of the underlying asset to go down. Thanks for dropping by today and listening in. We hope what we explained today about bull put spreads did make sense. If you've got questions, leave them in the comment section and we'll respond. And if there's anything you want us to cover on this channel, do leave us a comment and we'll definitely look into it. If you haven't done so already, please hit that subscribe button and hit the notification bell icon so you don't miss new content as soon as they're uploaded to the channel. If you know anyone that will find this video informative, do us a favor, do them a favor, share this video with them. Don't forget to sign up for the financial literacy program that we talked about earlier in this video. And you can check us out on these other social media handles. See you on the next episode.